Just to offer up a really quick sort of overview around the middle market, leverage finance market. So I think it's safe to say we're on the other side, right, of the peak of the market. And so, so previously, we actually saw, the time of easy money, very light covenant structures, at least as it relates to BDCs in particular. You also had, while you had a slight premium to sort of the money-centered banks offering in terms of the pricing on yield, you also had, enhanced flexibility around both terms and structure. We're on the other side of that now, so we're actually starting to see an increase in the pricing in terms of the overall yield. We're also starting to see some tightening overall as it relates to both covenants as well as term specific. The best advice that I'd actually say is the advice that we're currently deploying as we actually think about, we prepare both at least our portfolio as well as we think about, the offers that we're making on new transactions, which is, we are preparing for inevitably a downturn in the economic markets. And so we're thinking through the way that we actually prepare, the way we prepare our internal financings. In fact, we're actually currently going through refinancings as it relates to our portfolio, specifically to actually pressure test the portfolio from a financing perspective for downturn markets. And so, so that's in addition to that, we're also actively thinking about ways to take dividends off the table now and to sort of prepare ourselves, for the next 2 to 3 years. And so we're ultimately thinking about leverage that way. Having said that, because we are leverage-bound investors, so one of the places where we look for innovation is we specifically look for places where we can actually introduce sort of what we characterize internally as mezz equity. So we think about ways that we can introduce, in particular in the offers that we're actually making, we look to actually capture enhanced leverage on the equity that we deploy. So there will be a mezzanine structure, right, in every offer that we make, where we're essentially looking to leverage the large pools of structured equity and sub-debt investors that are out there to look to bring them into the capital structure to function as preferred equity on our transactions. Preferred equity with sort of the PIK cash interest, essentially providing enhanced leverage for the common equity that we're investing in. And so given the amount of capital that's out there, there's still appetite and desire for them. Having that mezz equity in our capital structure, it actually prevents us from enhancing the overall sort of leverage risk and profile, given that it's not cash interest pay, it's PIK. And so that's how we think about using it and enhancing it and actually structuring it to get enhanced returns on our common equity.